up, crew? In the last live stream, we spoke about moving averages. This is one of the most fundamental and game-changing concepts to understand in any form of financial market. So here's a step-by-step tutorial. Stay tuned until the end.
Honestly, my jaw dropped when I finally understood how moving averages work, and my whole world opened up into how fascinating crypto charts and trading can be. Because you know what? Crypto and trading uses mathematics as magic. It is absolutely beautiful. All right, moving averages is a statistic tool that smooths your price data. So obviously when we look at charts, often we see a lot of noise. We see the charts banging around like rodeo to the up and the downside, and we need tools that can make us feel sane. We need tools that can help us against analysis paralysis. And moving averages is one of those tools which smooths our price data over time to give us very nice, clear trends. The two main types of moving averages that you need to understand are your simple moving averages, or simply your moving averages, and secondly, your exponential moving averages. All right, there we go. You can see I have my MA cross. I'm also using my exponential moving average cross. Very important to understand how to use both of these. The moving averages, or your simple moving averages, are for understanding your larger perspective and your larger trend. Your exponential moving averages are for getting your smaller time frame entries, as they are on a more immediate algorithm. All right, the purpose of moving averages is actually threefold. First of all, to identify trends. Second of all, to identify dynamic support and resistance on the charts. The third one is to identify potential reversal points. Setting up your chart. First of all, I would recommend either TradingView or Bybit for using your moving averages. Usually I would just say TradingView, but moving averages are very useful for actually giving you real-time scalping data for your entries and exits, for telling you exactly where to enter, for telling you exactly where to exit on the crosses. So right now you can see I have my Bybit trading chart open, and I have my moving averages cross as well as my exponential moving averages cross. To find this is relatively simple. You come to indicators, you type in MA cross, and then you come and you select your moving average cross. Number two, you type in EMA cross, and you come and you select your EMA cross. First one we're going to talk about is to understand your larger trend. And you can see here on my moving averages, I have the 50 over the 200. This is known as our golden cross indicator, and it is extremely useful for understanding larger market trends. And on all markets, not just crypto, on indices, literally oil, gold, Forex, most traders will use this to understand their market cycle. So if we look at our previous market cycle, we can see very clearly where these crosses occurred. What we're seeing here at this green line is our 50-day moving average. This is our shorter term moving average in this cross. We are crossing the 50 with the 200. This orange one is our longer term moving average. And basically what this is telling us is that this line, this green line over here, is the average price over the last 50 candles on this time frame. This line is the average price over the last 200 candles. And this is absolutely magic for understanding the charts. We can see here when the death cross occurred, that was pretty much the confirmation to sell a large amount of your Bitcoin portfolio. I'm not saying all of it. And even when I say large, I mean only about 25%. But we can see that if at this death cross, you sold 25% of your portfolio, you were then able to make an extra 60% to the downside on that sale. And when the 50 crossed the 200 again to give us our golden cross, this was the signal that the trend had turned around on the larger market cycle. And if you had have then gone and bought back in that 25% from this level, you can see that you could have made, there we go, a 272% up. And that even carried on further and further, all the way up to our all-time high at about 450% from the golden cross. Even now we can see something a little bit scary. We are threatening a potential death cross. We can see how the markets were playing with our emotions back here where we received a death cross. Many people said, you know what, it's over, it's bear market time. But then Bitcoin did Bitcoin things and it came and very quickly gave us our golden cross. Again, I want you to experiment with different time periods. I like to keep it simple with my simple moving averages, and I like to stick to the 50 over the 200. Now we're going to talk a little bit about the exponential moving averages. So as I said, these are more for your entries and your exit points as opposed to larger trend. So we can see here that this is useful to actually scalp with and find your trends. Right here we can see the 9 over the 26. So what I like to use on my exponential moving averages as a scalper is the 9 as the short-term moving average and the 26 as the longer-term moving average, right? When we get the cross of the 9 over the 26, we get some beautiful moves to the downside. When we get the cross to the upside of the 9 over the 26, we get some beautiful moves to the upside. And this happens time and time again. This is for the more advanced traders, but it can also help you to get your entries for the larger time frames. Sometimes these exponential moving averages can help you to identify when exactly to enter your trend. There is the cross, and look at that beautiful trend. Right, I have come to enjoy the 9 over 26 personally, but I want you to experiment and find what works best for you. So let's speak now about how to interpret these moving averages. And let's bring back our moving average cross of the 50 over the 200. And you might think, oh, it's so difficult to find a cross. We do not often get crosses. So what happens if you are in the markets during this time? And basically, the major thing to understand here is that when the price is below your slower moving average, which is your 200, when price is below your 200 daily moving average, you are technically more likely to be in a bear trend. When your price is above your slower moving average or your longer term moving average, you are more likely to be in an uptrend. This is extremely important dynamic support and resistance that really nothing else on the charts can tell you, right? We can see here how price literally sat on this long-term moving average right here as support. As soon as we broke the support of this long-term moving average, it flipped into resistance. Please watch my support and resistance tutorial, that this is very dynamic support and resistance, meaning it is not in a straight line. It is dynamic, it moves, but it is to the dollar. Right here we sat on it as support. Here we broke the support to the downside, and here we retested that broken support, flipped into resistance, clear as day. Then of course, we also have our crossovers, and this is where it gets extremely interesting. We spoke about our death cross, throwing our whole market cycle into a bear market. This is your faster moving average, crossing over your slower moving average. So right here, of course, we would have actually wanted to enter from the support. And this, of course, was a golden pocket. Right, this whole area was a golden pocket. Go and watch the Fibonacci tutorial. We broke down how that area was a golden pocket. So that is why we entered. Then the bullish cross, the golden cross, was a confirmation that this was a beautiful trade. And then at the retest of The flipped resistance as support is where we could have added to our trade. And this does really get interesting when you start to use your exponential moving averages, which are, of course, your more immediate entry signals. So you use your slower moving averages to identify the trend. Then you use your exponential averages, the crossovers for your entries, as well as your exits. When your shorter term moving average crosses over your longer term moving average to the downside, this is known as a bearish cross, right? And that's when you can start to entertain your short trade. In terms of exits, you just look at that in reverse. You look at where does your faster moving average cross over your slower moving average to the upside. And that is where you can see you would have exited that trade. Then we entered into quite a flop and grop, no trading zone. And it wasn't long before we entered into a nice trending zone once again. Beautiful bearish cross of your 9 exponential moving average over your 26 exponential moving average. And then an exit of the trade. Finally, boom, 49% down, where your 9 exponential moving average finally crossed back up above your 26 from the downside.
Thanks for watching, crew. Show some love with a like and a share, and subscribe to the channel if you're new. Also, join my trading academy on Telegram for all of my updates, and of course, always play from a position of power and strength.